One thing I wanted you guys to talk about a little bit that was in the bill was, and this will be going into 2026, but catastrophic and bronze plans now. You can have an HSA. Sean, I think you may have dug into that. Can you kind of flesh that out for us?
Yes, so great point, Jackie. As we record this, they're still in the so-called government shutdown, so there's still I's to be dotted, T's to be crossed. We don't have the full picture from today versus when this episode drops versus New Year's Day. But what we do know is in July, the One Big Beautiful Bill made an interesting change to ACA plans. What it said was all the bronze plans and all the so-called catastrophic plans starting in 2026 will qualify as high deductible health plans. So that's a fancy way of saying in 26 and beyond, if you're on a bronze or you're on a catastrophic, bam, you qualify for a deductible HSA contribution. And I've jokingly referred to that as bronze is gold, because what you could do with that deductible HSA contribution, if you're an early retiree, say, or you're self-employed, you make the HSA contribution and you take a tax deduction for that, great. You also get to remove that from your adjusted gross income, meaning that you might be lowering it such that you qualify to get under the 400% of federal poverty level cliff, which as of this recording is still in effect for 2026. Or maybe you're already below it, but great, you now increase your premium tax credit. So it's a deduction that then helps with the premium tax credit. And it creates a tax-free pool of money. So if you actually have the sprained ankle or some other medical expense, great, whip out the HSA debit card and use it, because the alternative might have been to have sold a capital gain asset to fund that medical expense. That triggers more income, lowers premium tax credit, or maybe taking it from a traditional IRA. Well, no, you have this tax-free pool of money. The other thing I'm going to mention is these catastrophic plans. Usually up until this year, they've really been mostly available for those under age 30, so not really the early retiree. Well, in September, Health and Human Services came out with some new guidance that sort of didn't get any press. I found out about this from a commenter on my YouTube channel, so thank you very much. What they did was they said, okay, starting in 2026, if your income is above the 400% of federal poverty level, we'll consider that an eligible hardship so that you now qualify to go on one of these catastrophic plans. And I think it's worth looking into. Now, I will say this. My initial inquiry into this, and it wasn't very deep, what I initially found is the difference between a bronze and a catastrophic is your premium might be 25 or 35% less, something like that. That's the general ballpark, and your mileage absolutely may vary. I was hoping, maybe it would be like 60 or 70% less. And then it's like, oh boy, maybe we should really consider this. So I don't know that the catastrophic is going to be the be all and end all if your income is above that 400% of federal poverty level, but it's absolutely worth looking into. And I will say, when we're marketing things, using the term catastrophic is probably not the best way to market them. And technically, the idea is it covers your catastrophic costs, and it can be a lower premium. So yeah, there's definitely some balls in the air, but I think bronze in particular deserve looking into because of this HSA rule that's going to come into effect in 26.
Well, Jackie and I believe that everybody should have access to an HSA regardless of plan, and it should be universal. Hopefully, we work towards that solution where the nation has access to it, and you don't necessarily have to have a high deductible plan because health costs are so high, and this is such a valuable account. Give consumers and taxpayers a little Benny, I would say.
Well, Bill, if we're going to make votes here, one thing I would love to happen is imagine if HSA contributions were limited, but they were limited at your out-of-pocket maximum, right? So let's say you have like a $12,000 out-of-pocket maximum for a family. I believe, again, this is opinions here, that I believe that you should be able to make an HSA contribution to that amount, right? So that at least that your maximum out-of-pocket for health cost are at least deductible, et cetera. So yeah, but yeah, I think as Sean mentioned, that word catastrophic, it doesn't mean it's like an awful plan. It's really just protecting you from the catastrophic. Just my bias here is I think that everybody should have a maximum out of pocket for their health costs, because that's something that can really crush you if you just have a kind of unlimited health cost, whether you're in retirement or not.
Yeah. Are there any hacks? Because everybody worries about the premium tax credit, and Jackie's really good at hacking this. What are some common hacks or concerns that might push you over the limits to not get your tax credit. Let's address that real quickly.
Yeah, Sean, I was kind of thinking if you want to move into the kind of the first phase of retirement, that actually plays into the use of HSA reimbursements, those tax-free reimbursements, as Sean calls them, PUCME, those previously unreimbursed qualified medical expenses, PUCME. Also the use of Roth IRA distributions. So we've been kind of hearing everybody's so focused on tax-free long-term growth with these HSAs and Roth IRAs, but using a Roth IRA distribution, especially if assuming that in early retirement, you're just taking back your contributions tax penalty free or reimbursing yourselves tax free from the HSA. Let's say that you have a spiky expense in retirement, such as medical or otherwise, or even pre-retirement, that maybe taking this tax-free money earlier is actually better than later to not spike your income. And as you're moving into early retirement and you're focusing on reducing your health premiums with the premium tax credit, actually pulling money tactically from a Roth IRA or HSA tax-free can actually kind of help you keep yourself from boosting up above that cap that's currently in place.
We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So Jackie, we'll see our audience next time on Catching Up to 5. Cheers.